Presented by Group 6, we are providing the annual report for 2023. The two companies that we chose for this project is Nike and Adidas. The history of Nike. Created in January of 1964, Bill Bowman and Phil Knight built one of the most notorious shoe brands in the world. Originally known as the Blue Ribbon Sports, these shoes were originally made for athletes, specifically track runners. Using a Japanese shoemaker, they opened their first store in Santa Monica, California. In recent years, Nike has delved into different types of shoes such as Air Force Ones, Low Dunks, and Nike Golf. They have also created apparel such as athletic wear. History of Adidas. These iconic three stripes that we know today as Adidas has a very humbling start, experiencing much trial and error along the way. The early years of Adidas are rooted in a small town called Bavaria, Germany, with the goals of creating the best equipment for athletes. The idea was all started by the ambitious Adi Dassler. The large and successful company that we know now began its journey in Dassler's mother's small wash kitchen. Adidas became a household name after the 1954 World Series Cup, when Germany beat Hungary while wearing those three stripes on their cleats. Table of contents. We'll first be covering our income statements, followed by balance sheets, then our cash flow, miscellaneous, and finally our conclusion. We will first be covering our income statements. We'll be delving into how the time interest earned ratio contributes and impacts both companies. Now, what is a time interest earned ratio? It evaluates a business' ability to pay interest expenses. If a business has a higher ratio, it shows the less risk to lenders and investors. If a business has a lower ratio, it suggests that the company may have insufficient earnings to pay their debt. So we have the income statements from both companies and calculated the time interest ratio for each year. To calculate the time interest earned ratio, we take the net income plus income tax expense plus interest expense divided by interest expense. For Nike in the year 2023, the ratio equaled to 22.64, and in the year 2022, it was 18.23. For Adidas in the year 2023, it was 3.12, and for the year 2022, it was 4.01. Nike in 2023 had a 22.64 time interest earned ratio. Their ratio suggests that the company is at a safe position, their income is higher than their interest expense. Adidas in 2023 had a 3.12 time interest earned ratio. Their ratio suggests that the company is considered an acceptable risk to invest in. Looking at Nike and Adidas' partial balance sheet for Nike, with the year ending in December 30th, 2023 and 2022, their total assets decreased by 7% and their equity decreased by 8%. For Adidas, the year ending in December 30th, 2023 and 2022, their total assets decreased by 12% and their equity decreased by 11%. We also used the cash ratio formula, acid test ratio formula, debt to equity ratio formula to compare the two companies. Nike scored higher in both 2022 and 2023. When looking at the acid ratio test, Nike scored a 1.5 while Adidas scored a 0.66, which means that Nike has more liquidity than Adidas. Adidas gives back to the environment and community in more ways than large donations. They host community events to raise awareness and funds to certain organizations. Adidas is known for hosting an annual Run for the Oceans, where every 10 minutes of running parlays global cleanup networks to remove waste from beaches. Nike does a lot with the community and gives their full support to various organizations. One organization we highlighted was Nike's support to both veterans and active duty military by contributing $625,000 to nonprofit organizations. With the two companies that we discussed, we have concluded that the overall best company to invest in is Nike. Adidas experienced a 5% decline in revenue, and their total assets decreased 12% and an equity decrease of 11% in 2023. When comparing both companies, Nike had a higher tie number, which is almost 20 times higher than Adidas. Overall, Nike is the best company out of the two companies presented to invest in.